The hypothesis is that they're issuing short-term debt, staying away from long-term debt like the 10-year bond. And by doing that, the price of this is a hypothesis now, but just so people get the mechanics of what we're talking about here before we start getting into the weeds on it. By doing that, by issuing fewer 10-year bonds than would be, shall we say, normal, if that was the case, the price of the 10-year goes up and the yield goes down. And that's what's been happening, by the way. But in my view, it's not caused by this issuance from the Treasury. It's caused the 10-year yield. I've recommended, by the way, many times I've recommended buying the 10-year. Remember? Buying the 10-year, because the yield on the 10-year is going down. And now it's about 3.9%. I think when I started recommending, it was about 4.8%. So the yield has gone down from about 4.8 to 3.9. When the yield goes down, the price goes up. So you get a huge capital gain. That's been a wonderful trade. Now, why did I think that was going to happen? I thought that was going to happen because we've had a contraction in the money supply. And when the money supply contracts, with a lag, inflation comes down and bond yields follow inflation. That's what's going on. So if you look at the numbers on the 10-year and focus on it, think in terms of the following sequence. Money supply down a year and a half, 2 years ago. Inflation, as a result, today going down. John Greenwood and I think it'll end the year at 2.5 to 3% on an annual basis. And now it's already down at 3%, but it's probably going lower. And next year it'll probably even go lower than 2.5%, given this unusual contraction we've had in the money supply. So that's what's behind driving the 10-year yields down, rather than this hypothesis and speculation that the Treasury is trying to manage the yield curve in some way. That's one point I'd like to make. The other point I'd like to make is that interest rates are not reflective of monetary policy. Changes in the money supply are reflective of the monetary policy. Monetary policy is not about changes in interest rates. Most people don't understand this. It's about changes in the money supply. And changes in the money supply eventually affect inflation, and that will affect the yield curve and interest rates. So that's my take. I think the article is a little bit of a tempest in a teacup kind of thing. What's really going on is the money supply. It's all about changes in the money supply. We have had a contraction in the money supply. The money supply, the stock of the money supply is lower now than it was in July of 2022. And that kind of contraction, we've only had 4 of those historically in the United States since 1913 when the Fed was established, and all 4 of those led to slowdowns in inflation and recessions. Actually, one of them, the one from 1929 to 1933, led to the Great Depression. So that's why I think this contraction will be like those contractions. Inflation will keep coming down, and later this year, we'll see continued slowdown in the economy and probably the start of a recession. The contraction in the money supply has caused the inflation rate to go down, and the yields follow the inflation rate. That's what's going on. Most people have no idea what the quantity theory of money is, that money is the fuel for the economy, and changes in the money supply with a lag, with a long and variable lag, affect inflation. And that inflation, again, with a lag, not a very long lag, is reflected in the yields on bonds. So the change in the money supply, then with a lag, you get a change in inflation. Then you get a change in yields on bonds because yields on bonds follow the inflation. If the money supply contracts, goes down, eventually, with a lag, inflation rates will come down. And if inflation rates come down, yields on bonds will come down. That's pretty simple. That's pretty straightforward. The Treasury issuing debt to the general public, the non-bank public, does affect the economic activity in the following way. If they issue the debt, what do? You pay for it with a check, and that reduces your checking account, and that reduces the money supply. So in that sense, it does have an effect. It's not unrelated to economic activity, because economic activity is driven, given the quantity theory of money, by the money supply and changes in the money supply. So in the hypothetical that I just gave you with you buying the debt, that reduces your checking account. You get a bond from the Treasury, okay? And in exchange for that, you write a check. And when you write that check, your checking deposit goes down. So if nothing else changes, that activity is something that slows the economy eventually down. Let's do the case where it wouldn't slow the economy down. They could issue debt. What if they sold the debt to the Fed? What if the central bank bought the debt and the debt was monetized then? And the credit to the government account that you were just talking about, that would go up. The Fed would buy the Treasury bills, the government account would go up, and the money supply would go up because the Fed would be issuing credit, basically. They would be creating money to fill that government account to buy the bonds. So in that scenario, it depends on who's buying the bonds. People get all confused. They think if the government is running a deficit, that has to be inflationary and it has to goose the economy. No, that's not correct. It depends on who they're selling the debt to. If they sold it to the non-bank public and the Fed did nothing, that would reduce our checking accounts because we had to pay for the bonds, and that would reduce the money supply, and that would slow the economy down. If the debt was sold to the Fed and it was monetized, that would increase the money supply and goose the economy. So you see what I mean? So you got to run through what's going on everybody's balance sheet. It's a matter of looking at the balance sheets. You got to look at the balance sheet of the Fed. You've got to look at the balance sheet of the banks. You've got to look at the balance sheet of the non-bank public. And you've got to look at the balance sheet, obviously, of the Treasury. Whoever is holding the debt gets paid the interest. By the way, right now, T-bills, Warren Buffett's hoard of T-bills now is larger than the Fed's. They're paying more interest to Buffett than they are the Fed. You got the right charts up there. The debt's going up, and that colored bar chart you had up there, that gives a rough breakdown of who's holding the debt and who's receiving the interest payments. And then I added a little color to the thing because, Buffett liquidated, the first quarter of the year, he's maybe the second, I can't remember if it was first or second, but he liquidated about half of his Apple stock holdings. And of course, by doing that, he receives cash and he invested a lot of it in T-bills. And his stock of T-bills is now actually larger than the holdings of the Fed. We have several issues here. Paying this interest now, tax, that comes out of tax revenue. Taxpayers pay money in, and a big chunk of what they're paying in taxes is just to pay interest on the debt. Interest is being paid for nothing. I mean, nothing is being received in any meaningful way by the interest that's being paid. The interest is just being paid to the people who have loaned money to the government in the first place. So their taxpayers are paying a lot of interest to receive nothing. That's point number one. Point number two, the chart that you have up there right now, you can see that thing skyrocketing. And the Congressional Budget Office has indicated that federal debt increases and levels are unsustainable. And if something can't go on, it will stop. So the question becomes, how could it stop? And there are only three ways that it can stop. One is that taxes could be increased. This would reduce the annual deficit. Two, that would be direct taxes. Indirect taxes, there could be an inflation tax. And if inflation kicked up, if they monetized more and more of the debt at the Fed, the money supply would go up, and just like it did after COVID, and we'd have inflation. And there'd be an inflation tax. So direct taxes or inflation tax, that's two ways. And the third way is for the government to rein in spending, cut spending. Those are the only three possibilities. Now, those are three possibilities. The only way I think that we're going to solve this thing long term, invoke Article 5 of the U.S. Constitution, have a constitutional convention, and at that convention, limit discussion to discussions about controlling the debt and government spending, and put in something like the Swiss debt brake. The Swiss had a referendum in 2001, and the Swiss debt brake was passed, and the Swiss Constitution was changed. And Now, the Constitution mandates that the budget has to be balanced, and also Swiss government spending can't increase any more rapidly than the rate of growth in GDP or the rate of growth in the economy of Switzerland. That's the only real solution to this, because there have been other attempts in the past to have statutory fixes. All attempts to statutorily deal with this deficit and debt problem that is not sustainable have not worked in the past. I don't think they'll work in the future. I think the only way to fix it is to have a constitutional convention, change the U.S. Constitution, and put in a Swiss debt brake. Increasing the money supply, we talked about that a little bit earlier. If you have a deficit, and the Treasury is selling the debt, finance that deficit, to the non-bank public, that actually reduces the checking accounts, reduces the money supply, slows things down. The alternative, what we did with COVID, about 90% of the debt that was being issued was actually bought by the Fed. It was monetized. And the Fed, to buy that debt, created money to credit the government account and buy the bonds. So that increased the money supply. And of course, as a result, we ended up getting inflation. So the little trick in the question there, who was that Tim asked that? Tim's question, he assumed that the debt would all be bought by the Fed and be monetized, and the money supply would go up and inflation would go up. That is a possibility, but the other possibility is that the Fed buys nothing. They don't monetize anything, and everything's sold to the non-bank public. In that case, the money supply actually goes down and inflation would come down. I think the only real solution to this thing, long term, not in the short term, long term will be to have a constitutional convention, focus on the solution to this unsustainable debt, and impose a change, make a change in the U.S. Constitution that incorporates something like a Swiss debt brake, that would say something like government spending can't increase any more rapidly than the growth rate in the U.S. economy, and the budget would have to be balanced. One of the three options that I gave, cut government spending, increase direct taxes, or increase the inflation tax. That's the only possibility, or just keep letting the thing grow on an unsustained basis. But again, if things can't go on, they will stop. And then you get into these three options. It's some mix of those things.